All right, dear students, in this lecture, we are going to discuss the concept of the accounting equation with some useful examples. Now, when you are dealing with the financial accounting, it is very important to understand the accounting equation because this is the base of the financial accounting. The financial accounting is for the external use. When you talk about the financial accounting, it is for the external use. Mainly. Now, when we are saying external use, it doesn't mean we'll not be using this internally. But by external use, we mean that this is the information that is going to be provided to the shareholders. This is the information that is going to be provided to the public in the form of the financial statements being issued. So financial accounting is all about the external use of the financial information. That is why it is very different from the management accounting you will be doing in the other paper. So accounting equation is a very important thing you need to understand when it comes to the financial accounting. Now, the first thing you need to understand is the introduction. What is actually the concept of the accounting equation? Now, we discussed the business in the previous video, and we also discussed the types of the business in that. When you are going to start a business, in order to start a business, you need the finance. Now, for example, I am going to start a business of the sports equipment, or sport accessories, whatever you call it. So the business is related to the sports. I'll be selling the equipments. I'll be selling the accessories. Now, in order to start a business, I need finance. Now, what I'll be doing with that finance? With that finance, I'll be buying an outlet where I'll be able to sell my equipments, or I need a website. Obviously, website will cost me as well. Similarly, I'll be needing a stock, which are the things which I'm going to sell. I'll be needing the furniture and basic aids to decorate my shop, etc. So I need the finance to start up the business. But when we are talking about the finance, there are two sources from where I can get the finance. The first source is my own capital, my own investment. And when I'm saying my, that means owner's own investment. Say, for example, I'm a rich man by family. I have my own savings. I have my own money to start my business. So what actually I did, I started my business with my own investment. And if you remember the terms chapter, my own investment or the owner's investment is known as the capital. We discussed this thing in the previous lecture, that capital is the investment of the owner. That is known as the capital. We also call it as equity or equity, whatever you pronounce it. What if I'm not having my own investment, or what if I'm not having my own investment in full? For example, I need to start my business for $1 million. I have half of it, 50%, but where this 50% will come from? I need 1 million to start the business. I have the 50% of my own, that is known as the capital or the equity. But from where that other 50% will be coming from? Obviously, I need to contact someone other than my own investment to provide me the finance. For example, the borrowings. Now, the useful way for getting the remaining 50% is from the bank. Go to a bank and ask them to provide you that remaining 50% finance. Now, this borrowing which you are doing is known as the debt or the liability. So what I can say now is I started up the business, and for the starting the business I need finance. Now I was not having my own finance in full. I was having the 50% of it. So I invested my own 50%, that is known as the capital. And for the remaining 50%, I contacted the bank to lend me the amount. And I did the borrowings. That is the debt and the liability. Now, I can say that the assets of my business worth 1 million in total. Out of this 1 million, 50% have been financed by the liabilities, which is 0.5 million, and the other 50% was my own investment, which is known as the capital. So now you can see the assets of the business, which worth 1 million in total, have been financed by two sources: half from my own capital and the remaining from the liabilities. That is why this equation is assets is equal to liabilities plus capital. The concept is very clear. The concept is very clear that the assets of the business are being financed from the two sources. Now, assets simply means whatever the business is having in terms of the resources. Now, you discussed in the previous lecture. It's about cash, it's about inventory, it's about having machinery, anything, etc. And the capital is the owner's investment. And this liability is investment which is other than the owner, and that is also going to be called as debt. But what if I say that I was having my own 1 million to buy all those assets required for the business? Now the equation is going to be assets is equal to capital. There is no liability. There is no liability because I was in no need to go to the bank. I was having my own investment. So there's no concept of the liability. So the shrink form of the equation is going to be assets is equal to capital because there are no liabilities. But what if I say that I was having no money to start the business and I just went to the bank to finance my whole business? Then that means the assets of the business, which worth 1 million, are completely financed through the loan, which is the liability or the debt. Then the shrink form of the equation is going to be assets is equal to liabilities because the owner is having no capital right now. So this is the concept of the accounting equation. This is the concept of the accounting equation that when you need to start a business, you need the finance. If you're going to start a business, you need the finance. Now, why you need the finance? Because you need to buy the resources for the entity. You need to buy, for example, the stock, you need to have the furniture, you need to buy some other essentials, which are ultimately the resources for the business. So how you can get the finance? The first source is the owner's own investment, which is known as the capital. But sometimes if the capital is not sufficient, then you need to bring some other finance into the business, and that finance is going to be the liability. Why we are calling that as a liability? Because you have to pay back those borrowings, you have to pay back that money which you have borrowed from someone else. By someone else means other than the owner. This is the concept of the accounting equation. So finance is required in order to start a business, and this finance will be used to acquire the resources required to the business, which we referred to the assets in the previous lecture. Now there are two major sources to finance the assets. Sorry, and this is the investment of the owner, which is capital, and other than owner, which is known as the liabilities. So this is the thing you need to understand right now. Now we are moving towards another concept, which is the base for the accounting equation. Now, the standard accounting equation is assets is equal to liabilities plus capital. That means at any point in time, if you see the assets of the company, they are equal to the liabilities plus capital because they are financed from two sources. Either they are financed from the liabilities or they are financed from the capital or both. So duality concept implies that there are two aspects of every transaction. Duality means two. There are two aspects of every transaction, and these aspects will be shown in the equation accordingly. Now, in the next slides, we'll be looking at the examples, and then we'll be plotting those things, we'll be putting those things in the accounting equation. But before that, you should remember the duality concept is all about that we'll be placing that thing, we'll be placing those transactions in the accounting equation, and they will be having two impacts. Like say, for example, let me tell you one thing. Now, when you talk about the asset, cash is your asset because cash is a resource. Now, for example, cash in hand. And the other is thing is, for example, bank. Now, bank means cash at bank. So you have the cash in hand and you have the cash at bank. Both of these are your assets. Like for example, what if you are having a cash of $500 and you are submitting that thing, depositing that thing into your bank account. Now, this transaction has two effects, two aspects. Your cash in hand is decreasing, but your cash at bank is increasing. And both of these are assets. So these are the two aspects. These are the two aspects. What are the aspects? The cash is decreasing. Cash is again an asset. This is the first aspect. The second aspect is the bank balance is increasing. Now, these two are the aspects. We'll be looking at the similar transactions shortly. The effect of the financial transactions on the accounting equation will be explained by looking at a series of business transactions. And now we are going to discuss those transactions. This is the example number one, setting up a business by introducing capital. Now, before doing this, you need to understand that when you are starting up a business by introducing a capital, now capital means investment of the owner. Some of the students might think that if the owner is introducing the capital, why there will be two aspects of the transactions? This is a good question if you're having in your mind. Do you remember the separate entity concept which we studied earlier? Separate entity concept. Now, the separate entity concept implies that the business and the owner of the business are two separate entities. So whatever the owner of the business is investing in the business should be recorded first of all. Every transaction should be recorded because the business and all of the business are considered two separate entities. And the second thing you need to understand is whatever the owner of the business is investing in the business is the liability of the business. I'm not talking about liability in the equation context. I'm just telling you a liability in some other context. Like if I have invested 100,000 in the business, in my business, because the business is considered to be a separate entity, then that means it is a liability of the business to return me that investment or to give me the returns on that investments. The business owes me that amount because I have invested that thing in the business. So this is the concept why you are recording up everything because of the separate entity concept. So if the owner of the business is investing in the business, this should be recorded. So Costas has decided to set up a small business selling football shirts from a stall in the marketplace. A very good business nowadays. He begins by putting $3,000 into the bank account for the business. And this transaction sets up the business and it is recorded in the accounting equation as follows. Now he invested $3,000. This is going to be recorded under the capital because this is the initial investment. And this initial investment is in the form of the cash, and cash represents the assets. So this cash in the business, which is $3,000, is actually the owner's equity. So if you didn't tell me any details and you just show me this transaction, then by looking at this transaction, I can straight away tell you that this cash present in the business worth $3,000 is actually the money which is invested by the owner, because it is clear from the equation. There's nothing under the liabilities. Liabilities are zero right now. So that means this 3,000 which is currently in the business is completely financed by the owner from their own money, and that is known as the capital or the owner's equity. So this transaction was having two aspects because we are dealing with the duality concept. So this transaction is having two aspects. The first aspect is the increase in the asset, in the form of cash, and then the increase in the amount of capital, which is the owner investment. So these are the two aspects. And you see the equation is balanced. Assets is equal to liabilities plus capital. So we are talking about assets is equal to liabilities plus capital. All right. Now we are going to do the second example, and the heading of the second example is borrowing money. Now you are taking some money from someone. Costas then obtain a loan of 4,000, from his brother to purchase a motor van for the business. Now a motor van is actually an asset, and you will represent that van under the heading of the assets. So you see van, already they were having a cash of 3,000, but as you know, that 3,000 was insufficient to buy a van. So what the Costas did, they actually took 4,000 loan from where? From brother. And brother is not the partner in the business. So that means you have to return him $4,000. So now if you see the total assets which the business is having is $7,000. 3,000 in terms of cash, 4,000 in terms of van. Now, how this 7,000 worth assets are being financed? Now, 4,000 is actually the loan which is taken from the brother to buy the van, and 3,000 is the owner's own investment. So business assets which are worth 7,000 now are being financed through two sources, the liabilities and the capital, or you can say equity and the debt. Now we are moving towards the example 3. And do you know what were the two aspects in the example number 2? Just mentioning again, I forgot to mention two aspects. Now the asset is increasing in the form of van, and also there's an increase in the liabilities in the form of loans. So asset is increasing and the liabilities are increasing as well. So this is something you need to understand. So assets and the liabilities. All right. Now we are moving towards the next equation. Example number 3, paying cash to buy another asset. Now it is clear from the name itself that the entity is buying an asset and they are paying the cash which they are already having. So, okay, so what are the two aspects? If you just write the two aspects before going to the transaction, so they are buying an asset, that means there will be an increase in the asset, and they are paying the cash for it. So there is a decrease in the asset in the form of cash. So one asset is increasing, the other asset is decreasing. These are the two aspects that you need to know. So Costas buy a market stall and pays $500 in cash. So the asset which increases is the stall and which is decreasing is the cash. All right, now you can just plot this thing in the accounting equation. There will be no change in the capital. Make sure you're paying the attention. There is no change in the capital because the owner didn't invest anything further. This asset was bought from the current cash, from the current investment which the business was already having. Because many students is having the confusion that when they just put this transaction, they changes the capital a bit. Like, can you see from the name itself that we are paying cash, which is existing cash, to buy another asset? If this equation was written in the form of like the owner of the business invested further $500 to buy the asset, then in that case we'll be putting that 500 in the capital because that is the further investment. But here there is no change in the capital because there is no investment. Similarly, there is no change in the liabilities. There is no change in the liabilities because we are buying on the cash rather than credit. So there will be an increase in the stall and then there will be a decrease in the cash. These are the two aspects. Now we are having the example number 4, which is buying assets on credit. Now, from the name itself, you can understand the two aspects, assets and liabilities. Asset is increasing because we are buying the asset, and the liability is increasing as well because we are buying on credit. When we are buying on credit, we owe that amount to someone. We owe that amount. That means we have to pay that amount to someone at the contracted time. Costas now bought some football shirts for $1,800. He buys these on credit and does not have to pay for them immediately. Now, the Costa is running up a football shirt business. Now, he has bought the football shirts, and these are the things which he is going to sell. And if you remember that the things which we are going to sell is known as the inventory, or we call that thing as stocks, inventory or stocks. These are the thing which we are going to sell in the ordinary course of business because his business is selling the football shirts. So he's buying those shirts because he need to sell them to the customers. And this is the current asset that will be realized within 12 months. So the two aspects in this transaction is that he is buying the shirts, which is the asset inventory. And because he's buying on credit, this will give rise to a liability. So you see, initially we were having a liability of 4,000. Now there is another liability of 1800, and this is due to the shirts we have bought, and that will be recorded under the assets by the name of the inventory. So still the equation is balanced. Now we are having example number 5, cash payment to settle a liability. Now you can just imagine, you can just see the two aspects by just looking at the name. So you are making a cash payment, so asset is decreasing, that is cash is decreasing, and you are settling up your liability. Settling up the liability means you are paying for your liability. And when you are paying the amount for your liability is decreasing. This was the payable which you recorded earlier. So Costas pay 100,000 to his suppliers for some of the shirts he purchased. Now there will be a decrease in the cash for 1,000, and also there will be a decrease in the liability. Again, the equation is balanced. Now we'll be studying that how the capital will be changes. How the capital will be changing. How the capital will be changing when there are some certain transactions. So the first thing you need to understand, the capital will change when there is some further investment. And this further investment can be in the form of cash. This further investment can be in the form of uh, some asset that, like for example, the owner of the business is bringing his personal car into the business. So that capital is in the form of the asset as well. Secondly, the capital will be changing when there is a profit. Now, what is profit? Profit is when you are having a benefit on something. For example, you are selling your stock in the profits. Now, where the profit will be included? Profit earned by the business belongs to the owner, so will be added to the capital because it belongs to the owner. And so the profit will be added to the capital. Similarly, if there is a loss, it will be deducted from the capital because it is the owner of the business who is going to enjoy the profit and bears the losses. Do you remember that thing which we studied earlier? Similarly, if there is or there are drawings. Now we studied that drawings is eventually a reduction in the capital because the owner is taking back some of the investment. Either it can be in the form of the cash or in the form of the assets. And then there is one more technical thing you need to understand. As I said, that the profit will be added to the capital. Now, how this profit is calculated? Profit means income minus expense. That means if your income is exceeding from your expense, for example, I bought a football shirt in $500. This was my expense, but I sold that shirt in $800. That means this $300 is the profit, which is income minus expense. So remember this thing, that when you are talking about the profit, this means income minus expense. So eventually, the income will be added to the capital and expenses are deducted from the capital. Because when you are adding the profit, that means income minus expense. So income is eventually added to the capital and expenses are deducted from the capital. This is the thing you need to understand. Now, for example, I say that the business received an electricity bill of $100. Business received an electricity bill of $100. Now they have just received it, they have not yet paid. So what is the impact on the accounting equation? Now they have to pay this electricity bill because they have received it, they have to pay to the relevant authority. This is going to be a liability. Bill payable. Bill payable is the liability which they are going to record over here under the liabilities. And this electricity bill is the expense for the company because utilities are the expenses. Now, how I told you to account for the expense, expense will be deducted from the capital. So what you're going to do is you will write the expense and this amount will be deducted from the capital. So the two aspects are the liability is increasing, the expenses are increasing, which are ultimately recording in the capital, and the capital is being reduced by that expense. So this is the thing you need to remember. Similarly, what if I say received interest income, $200 on a deposit account. Now you are having the surplus money, and that surplus money, what you did, you're having the surplus money of your business, and you actually deposit that business money into a business account, and now you are receiving some interest on that. So how this will be plotted in the accounting equation? Because the business is receiving $200, so it will be recorded in the cash or the bank under the asset for $200. Similarly, this interest income is actually the income for the business. And I told you that profit is added to the capital and profit is calculated as income minus expenses. Expenses will be deducted as we have seen in the case of the electricity bill. And now this is the income which will be recorded under the capital, and this will be added to the capital. So interest income will be recorded over here. So the two aspects are, there is the increase in the assets in the form of the cash or bank, and there is the increase in the capital due to the interest income. This is what you need to understand. So the changes in the capital will be due to the further investment. If the owner of the business is making further investment, it is going to be when there is a profit, losses, income, and expenses. Now, when you talk about the income, it can be a rental income, it can be an interest income, it can be any other income. When you talk about the expenses, expenses about the utilities, you have the rent expense, electricity expense, gas expense, staff entertainment expense. You need to understand the nature of that expense over there. Now we are dealing with the example number 6, and it says cash sales. Cash sales mean you are selling something on cash, so the cash is coming into the business. Cost of sales. Now whatever you are selling will be having a cost. For example, I am selling a shirt. Now that shirt has a cost. Cost of sales. What is the cost of that shirt? The amount which I paid to my supplier. For example, I bought the shirt for 200. That this is the cost of sales. Cost of sales. Cost of what I'm selling. And the cost of what I'm selling is actually the thing which I bought from my supplier, and the profit. Now the equation is the costers sell 50% of the shirts for 1200 cash. Now do you remember we were having the shirts of 1800? They have sold 50% of it. That means the remaining 50% is there, which is 900. So the shirts worth 900 has been sold, and these shirts are sold for 1200. So the cost of sales was 900 and we sold these 900 shares for 1200, thus making a profit. So 1200 minus 900, income minus expense is 300. Now this 300 is the profit which will be added to the capital, and 1200 will be added to the cash. So this is how you are going to plot this thing in the accounting equation. So we have the assets, we have the capital. There's a change in the assets, there's a change in the capital. So we sold shirts of 900, so we deducted it from the inventory. Now we only have the inventory of 900. We sold these shirts for 1200, that is being added in the cash, and then 300 is the profit which is added in the capital. Now we have example number 7, and now we have the credit sales. Now the credit sale means we are selling something but on credit. We are not receiving any cash. Not receiving any cash right now. Not receiving any cash. And if you remember the previous lectures, when we are selling something on credit, that will give rise to a trade receivables. And if you remember, we also call that thing as debtor, trade debtor or trade receivable. This is the person who owes us the money, who owes the business the money. So we have to receive this thing. Costa sells shirts for 900 to a shop owner in another town. These shirts originally cost 500. So the cost of these sale was 500. So we were having the inventory of 900. Now we sold the inventory of another 500, and we are remaining up with the 400. So we are remaining up with the inventory of the 400. This 500 has been sold for how much? For 900. Again, we have sold for 900. The cost of those shirts were 500, so we have made a profit. Now this profit will be added to the capital. And we are not receiving any cash. That is why you can see there is no movement in the cash. In fact, we have to receive this amount from that person later on. So we will be recording this as receivable. Now, received means when you have received it, when you are about to receive it, when you have to receive it, that is called as receivable. So it's a debtor, receivable. The rest of the equation remains the same. Now we are talking about the drawings. Now I told you that the drawing is actually eventually a reduction in the capital. A reduction in the capital. So remember one thing, that when you are talking about the drawings, this can be either in the form of cash, like the owner of the business is withdrawing something in the form of cash, or it can be in the form of the inventory. For example, I am a fan of the Real Madrid club, and there's a match of the Real Madrid, and I want to make sure that I'm just wearing the shirt of the Real Madrid as well. So what I do, I just take one shirt from my business for myself. This is the drawings. Now, why the owner of the business should be recording this thing? Why? Because of the separate entity concept. That owner of the business, owner and the business are two separate entities. So whatever the owner is taking from the business, he should record that thing. Now you have an example, drawings. The Costas decide to take 400 in the cash out of his business. He also takes inventory with the value of 200. Now, do you remember we were having with the inventory of 400? Now he takes 200 for his own use. Now we are remaining with the 200 inventory. The cash was 2700. The cash was 2700, and he's taking 400 from that. So that will make 2300 remaining. So the total drawings are 600. which will be deducted from the capital, because drawing is eventually a reduction in the capital. So these are the things you need to remember when you are doing the accounting equation. So we have seen many examples, and then we have plotted those things, we have put those things into the equation. So make sure you are just getting the concept of the accounting equation. It starts with that the business will be financing their assets from the two sources, and then there is a general equation, the standard form of equation, and the duality concept, that whenever the business is doing the transactions, that will be having two aspects, and those aspects will be shown in the accounting equation, and then you did the different examples for it. So make sure you are just plotting the correct thing into the equation. This was all about accounting equation. Hopefully you understood the concept. Take care.